Quick question. What if I told you the best investment strategy for the last 5 years might be the worst one for next 5? Not because anyone got smarter or dumber, just because the market itself is about to change character. And most portfolios are built for exactly one kind of market. Here's what most people do. They look at how a strategy has performed recently, and they assume that performance is the strategy. If equity has been on a tear, just stay in equity feels obviously right. If markets have been choppy and going nowhere, safety first feels obviously right. It seems reasonable. You're reacting to real, recent evidence. The problem is that markets don't stay in one mode. They cycle. And a strategy that's optimized for the mode you're currently in can quietly become the wrong strategy the moment the mode changes. Usually right when you've built up the most conviction in it. Let's break this down properly, because markets change is too vague to actually plan around. In practice, a market is doing one of three things at any given time. It's rising strongly, a bull phase. It's moving sideways without much direction, range bound, or it's falling, a bear phase. A single strategy portfolio, say one that's 100% in equity, or one that's parked entirely in something safe, handles exactly one of these well and struggles with the other two. Bull markets reward participation, and only participation. When markets are rising steadily, the strategy that wins is simple. Be invested, be in growth assets, and let compounding do the work. This is the environment where equity-only portfolios look brilliant, and it's also the environment that trains investors to believe equity-only is always the answer. The catch is that nobody rings a bell when the bull phase ends. Range-bound markets punish that same equity-only approach. When the index moves sideways for an extended stretch, up 10%, down 8%, up 6%, down 5%, net going nowhere for a year or two, a pure growth asset strategy tends to deliver flat or low single-digit returns during that stretch. Nothing has technically gone wrong. The strategy is doing what it does. It's just that what it does isn't well suited to a market with no clear direction. This is also historically the phase where investors lose patience fastest, because there's no crisis to blame, just slow, quiet underperformance. Bear markets expose the cost of having no downside plan. When markets fall meaningfully, an equity-only portfolio falls with it proportionally, sometimes more than proportionally if there's concentration or leverage involved. A strategy with some built-in downside cushioning, a different asset class, or a structure designed to hold up better when equity doesn't, behaves very differently here. It won't necessarily go up, but it can meaningfully reduce how far the portfolio falls, which matters enormously for whether an investor can psychologically stay invested through the recovery. And here's the part that ties it together. You don't get to choose which of these three phases you're in when you build your portfolio. Nobody can reliably call in advance whether the next 3 years will be a bull run, a sideways grind, or a correction. That's not a knowledge gap you can close with more research. It's genuinely unknowable in advance. Which means a strategy built to shine in only one of the three regimes is, structurally, a bet on guessing the regime correctly. A strategy that's designed to hold up reasonably across all three, not best in class in any single one, but never badly broken in any of them, is a bet on not needing to guess at all. This is the core logic behind combining growth-oriented assets with something that behaves differently, a second building block whose job isn't to maximize the good years, but to reduce how bad the bad years and the flat years feel, so the investor's actual behavior doesn't derail the plan. Think of it like packing for a trip where you don't know the weather. If you're certain it'll be sunny the whole time, you pack light and travel fast. And if you're right, you win. But if it rains even for 2 of the 10 days, you're stuck. Packing one layer for rain doesn't slow you down much on the sunny days, but it changes everything on the days it rains. In investing terms, a blended approach doesn't try to outperform a pure equity approach in every single bull year. Historically, and this is illustrative, based on past, backtested behavior, not a guarantee of future results, the value of a blended approach has shown up specifically in the range-bound and falling years, where it's cushioned the ride enough to keep an investor from bailing out at the worst possible time. The question to ask about your own portfolio is not, has this worked lately? It's, what happens to this if the market's personality changes next year? If you don't have an answer, that's worth figuring out before the market gives you one. That's the core idea, building for the market you might get, not just the market you've had. That's it for this one. Thanks for watching. Check out the video description. We've packed it with resources just for you. If you found this video helpful, please give it a thumbs up and share it with someone who needs it.